In March 2025, American beef exports to China came to a screeching halt, sending shockwaves through the entire U.S. agricultural sector. What had been a steady, lucrative trade route was suddenly frozen, with no warning or explanation. China, a crucial market for American beef, quietly let export registrations for U.S. beef facilities expire. No official announcement, no press release, just a wall of silence that left exporters scrambling for answers. Overnight, $1 billion trade relationship vanished. U.S. ranchers and exporters who had relied on China's demand for years were left stunned and confused, watching their business evaporate in real time. Weekly shipments, which once averaged nearly 2,000 metric tons, plummeted to just 54. Warehouses filled with unsold beef, and shipping docks that once bustled with activity, now stood eerily quiet. Economists confirmed the worst. U.S. beef exports to China had essentially hit zero. The numbers were stark, and the implications even more so. The collapse was swift and total, leaving no time for American producers to adapt or seek alternatives. Ranchers, plant workers, and exporters all faced an uncertain future. The roots of this disruption traced back to late 2024, when China began investigating surging beef imports, citing oversupply and the need to protect local farmers. Tensions had been simmering for months, yet the method, letting registrations lapse without direct confrontation, felt like a calculated geopolitical move, a quiet but powerful message in the ongoing trade chess game. For U.S. farmers, this wasn't just about trade, it was a direct threat to their livelihoods, their families, and the communities that depend on agriculture. Chinese consumers favored specialty cuts less popular in the U.S., maximizing value for American producers and creating a unique, profitable niche that suddenly disappeared. Losing China meant losing a premium market, with ripple effects stretching from Montana ranches to Midwest meatpacking plants, and even to small towns built around beef production. The suddenness left no chance to find new buyers or pivot to other markets, plunging the entire industry into deep uncertainty and forcing many to question what the future might hold. China's move was rooted in domestic pressures. Facing a glut of beef and pork, local prices were falling, threatening Chinese farmers. The government, prioritizing rural stability, saw foreign beef as a threat. The late 2024 investigation signaled Beijing's intent to intervene. With domestic herds growing and consumer demand slowing, the market was oversupplied. Cutting U.S. imports was a blunt but effective way to stabilize prices and support local producers. This fit China's broader dual circulation strategy, boosting self-sufficiency and reducing reliance on rivals. The ban was as much about internal economics as it was about external politics. By letting U.S. export registrations expire, China protected its farmers and sent a message to Washington. It was a calculated act of economic self-preservation, with strategic overtones. For China, the move solved a domestic crisis and advanced its long-term goals. The news from China hit American ranchers hard. For many, China was a vital market, gone in an instant. Cattle prices dropped as surplus beef flooded the U.S. market. Cuts prized in China, like short ribs and organ meats, now sold at a loss or sat in storage. The loss couldn't be offset by domestic sales. The trade was specialized and high value. Ranchers who invested to meet China's standards saw those efforts wiped out. The emotional toll was immense. Multi-generational businesses faced sudden uncertainty. The closure felt like a betrayal driven by politics, not product quality. American producers were left with world-class beef and nowhere to send it. The ban hit not just ranchers, but corporate giants like Tyson, Cargill, and JBS. These companies, pillars of the American meat industry, suddenly found themselves at the epicenter of a global trade shock. Their operations, built for scale and efficiency, were not designed for abrupt market closures. For years, these corporations had invested heavily to serve China, the world's second-largest importer of U.S. meat. They had tailored supply chains, packaging, and even product specifications to meet Chinese demand, betting big on a lucrative and growing market. Suddenly, beef destined for China was stranded, forcing costly storage or discounted sales elsewhere. Warehouses filled up with unsold inventory, and shipments were rerouted at the last minute, often at a loss. Production lines had to be retooled, and financial forecasts were thrown into chaos. Executives scrambled to adapt, but the speed and scale of the disruption left little room for error. The beef trade with China was worth $1.2 billion annually, a core part of their business. Losing access to such a vital market meant a direct hit to revenue streams and long-term growth plans. Already squeezed by high domestic cattle prices, the loss of China compounded their challenges. Margins shrank, and the pressure on both suppliers and processors intensified. The silence from Beijing left companies unable to plan. Was this temporary or permanent? With no guidance, executives faced a fog of uncertainty, unable to make critical decisions about staffing, production, or investment. Industry groups called the situation unprecedented with no clear path forward. Trade associations scrambled to lobby for answers, but the lack of communication only deepened the crisis. Trade issues usually involve negotiation. This time there was only uncertainty. The usual channels for dialogue and dispute resolution were eerily quiet. The lack of communication paralyzed decision-making and threatened shareholder value. Stock prices wavered as investors grew anxious about the future. For these corporations, the China dream had become a costly nightmare. What once seemed like a golden opportunity now threatened to unravel years of progress. The fallout rippled through logistics, operations, and Wall Street. Every link in the supply chain felt the shock, from plant workers to global investors. The industry faced a strategic crisis with no easy fix, forced to confront a new reality where global markets could vanish overnight. China's demand for beef didn't disappear, it shifted. The $1.2 billion US market was a massive prize, now up for grabs. Brazil, Argentina, and Russia quickly moved to fill the gap, offering competitive prices and strong ties to Beijing. For them, America's loss was a golden opportunity. Every dollar China no longer spent on US beef flowed to these competitors. Years of US market building in China were erased overnight. The loss wasn't just sales, it was a long-term erosion of market position. The episode exposed the risks of relying on a single, politically volatile export market. The void left by the US is now being filled by nations China sees as more reliable partners. The financial and strategic costs for America are immense. Russia stood out among the nations rushing to replace US beef in China. Moscow's pivot to Asia and deepening ties with Beijing made this a strategic win. Russia's beef exports to China surged, supported by streamlined regulations and Kremlin backing. For China, Russian beef was a politically safe, reliable alternative. The US ban accelerated a trade relationship Russia had been building for years. While American producers scrambled, Russian exporters signed new contracts. In today's world, market access is shaped by politics as much as price. Russia's quick move was no accident, it was the result of long-term planning. The beef trade now strengthens the Beijing-Moscow alliance, shifting global power. For Russia, this was more than profit, it was a strategic victory over the US. The 2025 beef ban was the latest front in the US-China trade war. President Trump's second-term tariff hikes on Chinese goods triggered swift retaliation. China targeted politically sensitive US sectors, agriculture chief among them. Letting beef export registrations expire was a precise, non-tariff strike. The Phase 1 trade deal, meant to stabilize relations, became a tool for leverage. China's message market access depends on politics, not just agreements. Non-tariff barriers like this are hard to challenge and create deep uncertainty. The move weaponized regulatory procedures, inflicting maximum pain with plausible deniability. Modern trade wars are fought with more than tariffs. They're fought with every tool available. The beef ban showed just how sophisticated and targeted these battles have become. Washington and Moscow responded to the crisis in starkly different ways. US officials scrambled for answers, caught off guard by China's silence. The American response was reactive: damage control, public statements, and attempts to find new markets. The lack of coordination exposed weaknesses in the US approach to non-tariff retaliation. Meanwhile, Russia was ready. Years of preparation allowed Moscow to act decisively, signing contracts and ramping up exports. Russian firms, backed by the Kremlin, capitalized on the opening without delay. The US tried to pressure China. Russia aligned with it. As America dealt with fallout, Russia quietly turned crisis into opportunity. The contrast revealed a broader geopolitical shift: confrontation versus partnership. In this new landscape, Russia's strategy paid off. America's did not. The 2025 beef dispute could permanently reshape global trade, sending shockwaves through industries far beyond agriculture. What began as a disagreement over food safety and tariffs has now become a catalyst for a new era of economic competition. Trade is shifting from free market principles to political alliances, as countries increasingly prioritize national interests and security over open markets. Nations may increasingly buy food from allies, fragmenting supply chains that once spanned continents. This realignment could mean higher prices, and less choice for consumers, as well as new winners and losers in the global marketplace. U.S. producers risk being locked out of markets controlled by rivals, facing uncertainty about where their products will go and how they'll compete. The crisis is a wake-up call: diversify or face vulnerability. American producers must adapt quickly, forging new partnerships and rethinking their strategies to survive. The U.S. will push to open new markets from Southeast Asia to Europe, seeking opportunities wherever they can be found, and working to rebuild trust with trading partners. Australia's recent lifting of U.S. beef restrictions is one example of this shift, showing how quickly alliances can change and new doors can open. China, meanwhile, doubles down on food security and self-sufficiency, investing heavily in domestic production and locking in long-term deals with Russia, Brazil, and Argentina to secure its food future. The trust that once underpinned U.S.-China trade is broken, replaced by suspicion and a sense of rivalry that may last for years. The future is more volatile. Market access can vanish overnight, and companies must be ready to pivot as political winds shift. Competitors like Russia are now entrenched, and the U.S. must fight for every market, using innovation, diplomacy, and resilience to stay in the game. This episode marks a turning point. Global trade is now shaped as much by strategy and politics as by supply and demand. The world's economic map is being redrawn, and the choices made today will echo for decades to come.